2 million Americans have lost their jobs in the last 6 months. You probably do not know any of them. You probably do. They are the ones who stopped posting on social media. They are the ones whose kids are not in this year's soccer league. They are the ones who switched from name brands to store brands and did not tell you. The recession is not coming. It is already here. By the time the official word comes down, the people who prepared will already be fine, and the people who did not will already be in trouble. This is the Recession File. US. Unemployment has risen for 3 consecutive months, the longest sustained uptick since 2008. Job openings are down 31% from their 2022 peak. The help wanted sign is disappearing from every main street in America. Temp work, the canary in the coal mine, is down 15% year over year. The unemployment rate for recent college graduates is 5.9%. For workers without a degree, it is higher, much higher. The people the official statistics almost never talk about, and yet the official recession call has not come. The talking heads continue to talk about soft landings. The people who actually own the economy, the small business owners, the commercial real estate brokers, they know something different. They have known for months. Economists call the gap between the official numbers and the real economy the K-shaped economy. The top of the K is doing fine. The bottom of the K is not. The textbook definition is 2 consecutive quarters of negative GDP growth. By that measure, we have already had 4 recessions since 2008. Most of them, nobody noticed. The 2022 downturn lasted 2 quarters. The media called it a recession for 6 weeks, then quietly moved on. That is not the recession most people mean. The recession most people mean is a job recession. A recession where you or someone you know loses their job. A recession where the small business on the corner closes. A recession where the restaurant you have been going to for 10 years puts up a for lease sign. That kind of recession does not show up in the GDP data for at least 6 months. By the time the textbooks confirm it, the pain has already been happening in slow motion across millions of households. Recessions do not hit everyone equally. The top 10% of earners lose almost nothing in a typical recession. The bottom 50% lose everything they do not have. The middle class loses the most in percentage terms: mortgages, car payments, student loans, credit card debt. One job loss away from financial ruin. Historically, they take 7 to 10 years to recover their standard of living after a major recession. The people who get through recessions best are not the rich. They are the ones with the lowest fixed costs. The ones who bought their house when it was affordable and paid it off. The ones who drive used cars. The ones who, on Instagram, look like they are not doing very well at all. The boring ones. The quiet ones. The same people we talked about in the dark dividend file. They are recession-proof and recession-ready for the same reason. They have less to lose. Forget the economists, forget the talking heads. There is one chart that has been flashing a recession warning for 9 months. The Federal Reserve does not want you looking at it. It is the yield curve. When short-term Treasury bonds pay more than long-term Treasury bonds, that is called an inverted yield curve. It has predicted every single US recession since 1969. Every single one. It is currently inverted. It has been for over a year. The bond market is smarter than the stock market. The bond market is smarter than the economists. And the bond market is currently saying a recession is here. The people who come out of recessions ahead are not the ones who react. They are the ones who prepared. They bought their house when they could afford it. They drove used cars. They kept their fixed costs low. They built a cash buffer of 6 to 12 months of expenses. They invested through the last downturn because they had already invested through the one before that. The people who lose the most in recessions are not the uninformed. They are the over-leveraged. They had a lifestyle that required everything to keep going up. When the music stopped, they were the ones without a chair. Here is what to do. Not the panic playbook, the boring one. Number 1, cut your fixed costs. Cancel the subscriptions. Downgrade the car. The lower your monthly burn, the longer you can survive a job loss. This is why the quiet rich drive paid off Camrys. They have been running this playbook for 30 years. Number 2, build a cash buffer. 6 months of expenses is the minimum. 12 is better. Put it in a high yield savings account. Do not invest it. The point of this money is not to grow. The point is to be there when you need it. Number 3, pay off your high interest debt, anything above 8%. Credit cards, personal loans, buy now, pay later. The single biggest thing that destroys families in a recession is high interest debt. It is a ball and chain. Number 4, do not sell your investments. The worst thing you can do in a recession is sell. The average recession lasts 11 months. The average recovery takes 3 to 5 years. If you sell at the bottom, you miss the recovery. The quiet rich do not sell. They buy more. They are the same people who, in 2009, quietly bought dividend aristocrats at half price. You already know what happened next. Number 5, increase your primary income, not your side hustle, your primary income. If your job is at risk, invest in a skill that is not. 6 months from now, you will either be glad you did or you will wish you had. Recessions are not the end of the world. They are the end of a world. The world where you could finance your lifestyle on credit. The world where house prices only go up. The world where a degree guarantees a job. That world is ending anyway. The recession just makes the ending official. The opportunity in every recession is the same. It is the opportunity to rebuild, reset your fixed costs, get out of debt, invest at the bottom. Come out the other side stronger than you went in. The people who do this are not the ones watching cable news. They are the ones who use the last 3 years to pay off their credit cards, build their cash buffer, and get their fixed costs under control. They are not scared of the recession. They have been preparing for it without calling it that. The recession is not the crisis. The lack of preparation is the crisis, and why almost nobody owns it. I will see you in the next one.